Good morning, folks, and welcome to today's video. So today I just have the one pair on watch, and that is Swiss yen. I've just taken some of the other pairs off of watch because some of them have pulled back a little bit more deeply, which has kind of made the sequence a little less reliable. So I'm just going to let some of these pairs show their hand. Some of them are just correcting. And as I've said before, I'm not going to try and guess what price is doing. I'm just going to let it show its hand. So just keeping them on the sidelines for the moment until the price develops a little bit further. But what I have got on watch, and I don't necessarily think this is going to be ready by the end of the day. But as I've said before, it doesn't really matter what I think. Okay, one of the things that I was thinking about this just before I went live. One of the things that lets traders down is they what they think is going to happen. Okay, so people get into a trade and they think it's going to do this, and then it does something completely different, and then it causes them a lot of emotional distress because they weren't open to the fact that the market could do anything at any time, which is something that Mark Douglas talks about in Trading in the Zone. If you've ever read that, he says the market can do absolutely anything at any time, and that's something that I fully accept and I've experienced from time to time as well. Also, on the flip side, it's important to have that kind of neutrality because, although I don't think this is likely to shape up what I'm going to be looking for Swiss yen by the end of the day, what a lot of traders do on the flip side is they say, yep, that's not going to be ready. I'm just going to go off and do other things. And then the market provides the entry that they would have otherwise been looking for. They don't take the entry. It plays out for a big percentage, and then that causes them emotional distress. So neutrality in trading is vital in my experience. So without further ado, and with neutrality in mind, let's break down this pair for you. So I'm going to probably go into a little bit more detail just because I have the one pair on watch today, but let's break this down. So Swiss yen, I can see we're at excuse me, we're at an all-time high here. Okay, if we just scroll left, as I've said before, scrolling left can often be your best friend, best friend, to help you determine whether you are actually trading in at an area of value or whether you need to be a little bit more cautious. We can see we are at an all-time high. Okay, so this is a place where I would expect the bigger players who caught this move to the upside to be getting out of their positions. What we know about these higher time frame liquidity points, and especially all-time highs, is that we typically break above before breaking to the downside. And what I see here is we break above. Okay, one of the things we also see is near misses before we get to these highs. So we come back up, we near miss to the high. And when we near miss, it's often the case that even if we sell off temporarily, we often find our way back up because the orders that were sat in this area that weren't tapped into and the orders that were sat just above drag price back up. So as people are trying to sell this, there's orders coming in at this area and orders that are still in this area that drag price back up that need to be filled before the longer term move to the downside can occur. So you can see that we did break above and we pushed to the downside, and we had confirmation at this moment in time by way of this high test candle. It did have a little bit of a wick below it, and I said that this could potentially be the start of an evening star formation. And notice I said the word potentially. Again, that's another example of being neutral. Okay, so we don't know what the market's going to do. And yesterday we had this candle here, which opened just below here, pushed back up. So we kind of have this indecision. We have a high test candle followed by a low test candle. By definition, that means indecision. However, we also have to remember that a high test candle, if it's placed down here, for example, if this candle was down here, this would be a signal, a confirmation candle to go long. Well, at an area of value to the upside, a low test candle like this is also a confirmation candle to go short. Okay, but when it's followed by a high test candle, this also means indecision. So we're getting indecisive candle closes at the moment. Okay, so what can we do about that? Well, on the lower time frames, there are ways we can determine whether we're trading into indecision or whether the market has shown its hand. And I'm going to touch on that as we drill down to those lower time frames. Now, we don't know if this is going to shape up by the end of the day what I'm going to be looking for. But one of the things that makes me think that we would likely in the coming days be most likely in the coming days be pushing to the downside is that we have a near miss to this low, and we have a near miss to this low, and we have a near miss to this low. So when we have a near miss to a low, just as when we have a near miss to a high, that increases the likelihood that we're going to come back down, take out the lows that we near miss to, and then what happens thereafter is for the birds, as I often say. It's not for us to determine, but we have structure here. We have psychological patterns that we look for, and the more near misses we have to a previous low, just as with on the flip side, if this chart was upside down, the more likely it is that these near misses and the lows that we near miss to um, will be taken out. Okay, so how have we moved up to this area? We've moved up to this area fairly correctively. This is a fairly non-progressive move to the upside, suggesting that this may just be an impulse correction continuation to push lower. Okay, so the move up was more corrective, I would suggest, than the move down. But regardless, we've tapped into that area of value now. So now I'm just looking for, let me just check the weekly. Yeah, just looking at the weekly, just having a quick look at that. So as I drill down, what I see here is you can see that this is, if we're normally speaking, if we're going to push to the downside, we don't normally see price correcting for this long. We normally see these smaller flags. We're on the 4-hour chart at the minute. We do have a nice bearish 4-hour candle there, but look how we've pushed up there. Okay. So if I just drill down to the 1-hour chart, normally speaking, we would see at an area of value. So we have this little reversal structure, this little mini reversal structure there, which has the 3 drives: first drive, second drive, third drive. We have that kind of middle section within it, implying that this is a little completed structure. We then push down impulsively, which is what I would anticipate seeing. However, normally what we would see at such a high area of value, if we were going to commit to the downside, would be these kind of tighter flags. So, start flags like this, and then typically speaking, we have a series of tighter flags. So they generally get a bit larger, okay, because what's happened was prices tapped value here, so it doesn't necessarily need to build as much volume to move to the downside because it's just tapped into some. But the further this goes, as I've said previously, if you think about volume, price is either triggering volume or it's building volume. Now, after prices tap the volume, typically speaking, the further into the move it gets, it needs to build volume for the next wave to the downside. So that's typically why the tight flags get larger and larger until we start to get into these bigger flags like that. Okay, that's a sort of typical sequence. So we wouldn't normally see price building so much volume if it's just tapped into some. Okay, so the next thing with that in mind, what I then do is I measure the impulse down, okay, to where how far prices pull back. Okay, now at this moment in time, that is not an unhealthy correction. We've pulled back just over 50% of the move, and I mentioned how on some of the more corrective pairs and Swiss pairs, price will often pull back 60% of the move before it commits to the downside. And you can see, so at the moment in time, that is not I don't see this as an unreliable sequence. Whereas with, I think it was pound yen or dollar yen, price had pulled back, prices pulled back about 60 to 70%, which is not typical what I would see for that pair. So that's one of the reasons why I can't remember which one it was, but one of those pairs off of watch. Okay. So because this is corrected, although it's not an unreliable sequence yet, this could be because of how it's corrected. This what could be happening here, given that we have to remember that although Swiss yen has broken an all-time high, it has been going up for a long period of time. Now, what this could be is some kind of middle section, okay, to push higher like that, okay, and then we end up with something like this. This becomes a 1, 2, 3. Okay, and we end up with something like that. We have a larger reversal structure. And one of the reasons that makes me think that that's possible is because although we did break this all-time high, we didn't really break it by much. If we just zoom back out to the daily rather, we only narrowly just tapped above. Now, generally speaking, with all-time highs, okay, we generally break above them by a notable amount of distance. We don't normally just slightly wick above them, okay? So that is giving me the clue, given how we've corrected sideways and not really committed, that this could be some kind of larger reversal structure where we get this, okay? And then, so why is that significant? Well, that's significant because it would therefore be a little bit more risky to try and be getting short in here, because you're potentially getting short within the noise, and you could be, tagged in, tagged out, and then price just messes around, okay, and does something like that before that higher time frame reversal structure. So what can we do to mitigate that? Well, one of the things we can do, and this is what I'll be looking for today, is if I'm just having a look at the 4 hour again. Right, okay. So what I'm going to be doing specifically is, so we've had a couple of corrections here. We've had a kind of one correction, second correction, and if we were to drop out, this would be a third correction. Okay. Now my trading plan states that after the first two corrections, I only look for risk entries within flags. So it's important to know what you're looking for in trading, and it's important to know what you're not looking for. Okay. Okay. Now, what I'm not looking for is a reduced risk entry on the break of the flag, specifically because my trading plan says that after two corrections, okay, from an area of value, I only take risk entries within the flag. And one of the reasons is because it would likely be a bit bigger than this if it was to form. One of the reasons is because if you take a reduced risk entry on the break of the flag, so something like that, okay, you're more likely to be tagged in, tagged out after price action such as this. Um, Whereas if you actually look for the risk entry within the flag, you've generally speaking, as I say, the type flag might be larger than this if it was to form. You've got more room to manage the trade if it was to do that, and you could potentially get your risk off of the table. Okay, so that's one of the reasons. The further into a move you get, the more you have to be a little bit aggressive with your management, or on, the more risky these tight flags become. Okay, but if we were to break below here. Okay, so if price action, as I've written here, if price impulse is down below our most recent low, then I'll be waiting for a subsequent three-touch type flag to form, and then I'll filter it on the 15-minute chart and be looking to get short with a risk entry within it if the flag is structured. Okay, so I'd specifically be waiting for a three-touch flag as well, because again, if you were to wait for a two-touch flag here after price action like this, then you could simply be tagged in, tagged out, and then price gives us that, and then we end up with that middle section that I was talking about, and that potentially that bigger reversal structure. Now, one of the things I did over the weekend, I'm just going to touch on this because it's just come to me, is that according to my documentation, since August 2020, I've only taken arguably four losses. I'd say arguably because one was arguably three touches. Um, Only taken three or four losses within or on the break of three-touch type flags, such as this. So that tells me that it tells me a number of things, but one of the things it tells me is that these are deliberate. When you see these three-touch type flags, they are deliberate. And even if sometimes you take them in poor areas, I wouldn't advise doing that. They tend to be a lot more reliable than two-touch structures if the price action isn't 100% clear, and if price could actually form into something else. So if we were to break below this low, we would also be trading below here, okay, below this high here, okay. And if we got a three-touch type flag there, that would be deliberate in my opinion and experience. And then I could manage this down to this first low. I don't think that holds much weight, but even that first low, I'd be able to manage that down to there for something in the region of 5 to 6%. And then our first solid target would be there for something in the region of 14%. And what I would do there is I would manage this. So I would take the range, I would take this range here, and I would pull this Fibonacci tool down to there. And what I would do is, because price often pulls back sharply once it gets to 90% of the range, is I would then set a take profit there while simultaneously trading my stop loss down to this area, and then I would walk away most likely with something in the region of 12% if we actually got to the take profit. Okay, now what would that look like if we look at that on the 4-hour chart? By that point, okay, the 4-hour chart holds a lot more weight. If you think about it, these 4-hour highs and lows right? By definition, if it's a 4-hour high, that means that there was a move up followed by a move back down. So there must have been one 4-hour candle here followed by a 4-hour rejection. That's 8 hours worth of candles. So on the 4-hour chart, these highs and lows are made up by an entire trading session's worth of price action. Okay, so whereas on the 1-hour chart, these highs and lows, as you see here, can be made up of literally 2 hours worth. That could just be a temporary stall in price due to low liquidity, or maybe some of the bankers went on lunch. Who knows? Okay, but on the 4-hour chart, these highs and lows are made up by an entire trading session's worth of activity. Okay, so they're more significant. So if we did get what I'm forecasting, then we would be trading below a significant low and below a significant high and below this low here, which we've recently formed. And then that would confirm to me that the floodgates would likely open for a move to the downside. And then, of course, the daily, we would be trading below that wick. You can't see it now, but that wick there, you can even see this on the daily charts. We would be trading below that. We would have retraced more than 50% of the body of this previous candle. So that would likely open the floodgates as well. Okay, so that's what I'm going to be looking for today, folks. And as I said, when I break down my pairs, normally there's a lot more thought process going on than I actually narrate in those videos. But it's difficult to explain the entire thought process and to explain, I'm still learning, but 4.5 years worth of experience in 20 minutes. However, when I have one pair on watch, it allows me to go into a little bit more detail. So that is what I'm going to be looking for today, folks. I hope you've enjoyed this video. As I said, this is not a signal service. This is just me trying to challenge the understanding of people that are perhaps newer to trading and perhaps have never seen the way that we trade before. Just me trying to challenge people's perspectives. Because if we as traders can remain neutral to the possibility that what we think we know isn't necessarily the only way to trade, and that there are other things to learn, as long as you you're aware that there's always more to learn, and that you'll never know everything about trading because there are always unknown variables in the market which none of us could possibly know, then you're on the right track, and you don't blind yourself with confirmation bias, which is what a lot of traders do. Okay, so that's my thought process. That's what I'm going to be looking for today, folks. I hope you've enjoyed this, and I will see you again in the next video. Thank you very much indeed for watching.